Welcome back to Investing Talk Podcast. Today, we're taking a close look at Element Solutions, a diversified specialty chemical producer with a pretty big global reach.
Yes, and we've gathered some recent reports to sort of unpack what's happening with them right now.
Right. So, your mission basically is to get a clear, concise understanding of Element Solutions' current financial health. Where they're seeing growth, what challenges they face.
And what it all might mean looking forward.
Exactly. Think of this as your shortcut, helping you feel informed without wading through piles of financial documents.
Okay, so let's maybe start with their recent financial performance. Q1 2025.
Good place to start. What are the top line numbers looking like?
Well, net sales reached about $594 million.
Okay.
Now, that's up 3% as reported, but if you look closer, it's actually a 5% organic increase compared to Q1 last year.
5% organic.
Yeah.
Remind us what that specifically means again.
Right, so organic means the growth is coming from their existing business operations. It strips out the impact of things like recent acquisitions or divestitures.
Yeah.
It's the core growth.
Got it. And looking inside that growth, there seems to be a real split, doesn't there? The electronics segment was, well, a major driver.
Oh, absolutely. It saw a 13% increase in net sales.
13%.
Yeah, and around 10% of that was organic growth. So definitely showing strength in that area.
Which really contrasts with their industrial and specialty segment. That saw a decline, right?
It did, about 12% down. Now, some of that, we should note, was due to them selling off McDermott Graphics Solutions.
Still, that's a huge difference between the two segments. 13% up versus 12% down. That kind of disparity. What's it telling us?
Well, it certainly shows how strategic moves like selling off a business unit affect the numbers. But it also really underscores, the different market conditions they're facing. Electronics booming, general industrial, less so.
It could suggest a strategic focus shift, maybe towards those higher growth electronic areas.
Could be, or at least that's where the current tailwinds are.
Okay, now here's something really interesting. Net income. It jumped massively.
How much?
75% year over year, up to $98 million from $56 million. That's quite something, especially with revenue growth being more like 3 to 5%.
Wow, 75%. That is significant. What's behind that, do you think? Operational efficiency.
That seems like the most likely candidate. Maybe better cost management, or perhaps they're selling more high-margin products within that mix.
That makes sense. It's sort of a classic sign of operational leverage kicking in, maybe optimizing supply chains or reaping benefits from past efficiency investments. It looks good for future profitability.
Okay, what about adjusted EBITDA?
That was $128 million, so up slightly, about 1% reported. But if you look at it on a constant currency basis, it's up 5%.
Right. And adjusted EBITDA, just as a reminder, gives you a clearer picture of core operating profit by stripping out interest, taxes, depreciation, amortization, that sort of thing.
Exactly. But then you look at cash flow.
Yeah, that seemed a bit different. Cash from operations was $26 million, and adjusted free cash flow was $30 million.
Which is down from, what, around $58 million the year before?
Yeah, $58.2 million. So quite a drop. Why is that decrease something we should, pay attention to?
Well, a drop in free cash flow like that, it could mean a few things. Maybe they invested more in working capital, perhaps building inventory for expected growth.
Or higher capital expenditures, investing in equipment or facilities.
Possibly. Or it could just be timing differences in payments. It's definitely something to keep an eye on, see if it's just a blip or a developing trend.
Interesting. Given that strong electronics growth, maybe they are investing more there.
It's plausible. Supporting that growth often requires investment.
Okay, so that's the income statement and cash flow side. What about the balance sheet? I saw they made a move on their debt.
That's right. They prepaid approximately $200 million of their term loans.
$200 million, that sounds significant. What's the impact of doing that?
It's a really positive step for their financial health. Paying down debt like that reduces their interest payments going forward.
Which frees up cash.
Exactly. Gives them much more financial flexibility. Maybe for future investments, maybe acquisitions, or just having a stronger cushion if the economy turns down.
Like paying off your credit card early, basically. Less interest, more money for other things.
A good analogy, yes. It strengthens their foundation.
So beyond the pure financials, let's talk about where Element Solutions actually operates. It seems quite diverse.
It really is. They're in agriculture, automotive, electronics, graphic arts, metals, finishing, even offshore oil and gas, a broad spread.
And the products reflect that diversity, too. hydraulic fluids, coatings, photopolymers, crop protection, under brands like True Height, Alpha, High Tech, lots of different things.
Hmm. So in such a varied landscape, what gives them their edge? What's their competitive advantage, would you say? Well, the diversification itself is an advantage, spreading risk. But I think right now, a key strength is their strong position in those high-value niches within electronics.
You mean like data centers and AI applications?
Precisely. They've noted that they're seeing sustained demand from their big semiconductor customers in those areas. That seems to be a major plus right now.
So they're really riding that wave, that AI and data center growth is a significant tailwind.
Definitely. But on the other side of the coin,
Is that softness in overall industrial demand we mentioned earlier?
right, and that's clearly impacting their industrial and specialty segment, as the numbers showed.
So it's a bit of a balancing act for them. Electronics pulling hard one way, industrial lagging a bit.
It is. And you always have the general background risk in the specialty chemical sector, potential regulatory changes, shifts in technology, things like that.
How does management see it? I saw CEO Benjamin Glicklich made some comments.
He did. He seemed pretty positive overall, highlighting the strong profit growth despite those industrial headwinds.
Pointing to that electronics strength?
Yes, and also mentioning the benefits they're getting from their diversification and from introducing new products, seems confident in their strategy.
And that confidence, coupled with the results, how did the market react?
It seems the market reaction was generally positive. The stock got some upward momentum.
Likely driven by the better-than-expected profit and that debt paydown.
I think so. Those are usually well received. But, as we've discussed, that weakness in the industrial segment, that might inject a little caution for some investors. It's not all smooth sailing.
A nuanced picture for sure. So looking ahead, what are the potential catalysts? What could drive performance?
Well, continued strength in electronics, especially AI and data centers, is number one. Keep an eye on that.
Okay.
Also, they mentioned new product launches specifically in power electronics that could be another growth engine.
And the debt reduction continues to help.
Absolutely. That ongoing deleveraging improves financial flexibility, which is always a positive.
And potential risks or hurdles.
The main ones seem to be the potential for that industrial market softness to persist or even worsen. And then there are the broader macroeconomic factors, interest rates, global growth, things that affect everyone.
So putting it all together, strong electronics, some industrial weakness, debt reduction, decent profitability. What's the takeaway? One source seemed to imply a hold recommendation. Does that feel about right?
Based on this snapshot, yeah, cautious optimism or a hold seems like a reasonable assessment. It acknowledges the clear strengths, particularly in tech-related areas, while also recognizing the challenges they're navigating elsewhere in the portfolio.
So wrapping this up, what does this all mean for you listening? Element Solutions looks like a company skillfully navigating a pretty complex market.
They're leveraging that booming electronics sector, especially the AI and data center links, which is smart.
But they are facing those headwinds in more traditional industrial areas. Still, their focus on higher value niches and getting their debt down seems to be working, or at least resonating positively.
And this really brings up a broader question for you to think about. How do these diversified companies, like Element Solutions, manage to balance growth in hot sectors while other parts of their business face challenges?
Yeah, and what does that kind of divergent strength here, weakness there, tell us about the wider economic landscape right now? It's quite interesting.
Definitely something to consider.
If you want to dig deeper yourself, you can check out their investor relations materials at ir.elementsolutionsinc.com.
And financial news sites like Bloomberg or Reuters will likely have ongoing coverage too.
So if you found this overview valuable today, please do subscribe, like this, and maybe leave a comment with any further questions you might have.
We aim to bring you these kinds of insights to help you stay informed in this complex market.